Well, folks, we've been talking about residential mortgage rates collapsing, falling. Last reported by Mortgage News Daily, last I saw was 6.04. 5.99 seems to be right around the corner, but this is very much a residential conversation. And you know, on this channel, we bring you both sides of the table. We have Jonathan Twomley to talk about commercial. So we're going to find out about rates in commercial. Are they falling? Are they rising? What's going on with lending conditions? Because it is a very different market. How you doing, Jonathan?
I'm doing great, Michael. Good to see you. We didn't get to talk last week, so I'm glad that we're back on schedule this week.
Yes. Yes. So I
So,
appreciate you. So what's going on in commercial? Because I don't know if you've heard, but the 30-year mortgage rate is falling. It peaked in October, I think, at like 7.38, and as of yesterday, it was 6.04. So almost down a point and a half,
mhm.
which is huge for residential. But I don't know if that plays in commercial or not.
Oh yeah, I mean, a drop like that is definitely something that would, gets attention in the business. And what I've been seeing recently is a little bit of the same thing. Now, we didn't have the rates go as high in commercial as they did with residential.
Okay.
However, they definitely spiked for sure. And but what I've been seeing is a couple of people who are mortgage originators posting what's going on with rates, and they've been talking about the same thing, about there being a little bit of relaxation
Hmm.
on the rates. So now, not as dramatic as what you're talking about with residential, but again, because it didn't spike up as high, the compression is not as dramatic either. But you know, uh, even 25 basis points on what you're paying on your loan makes a big difference in terms
Sure.
of your ability to get the loan, and how profitable you're going to be with the loan. So relaxation will definitely help things. Uh, well, depending on what you mean by help, but yes,
Yeah.
it's not unwelcome that rates may be declining, but we'll sort of see how far it goes, especially if the Fed continues to raise rates. That's
Mhm.
going to push up the baseline on which everything else is calculated. But
Yeah.
yes, so a little bit of easing in the
Okay.
markets for commercial as well.
So in residential, the most quoted rate is a 30-year fixed. Would it be fair in commercial to say it's a 5-year arm is kind of if you were going to pick the most common? Is that it or
Well,
something else?
no, I mean, well, it really depends, because it depends on a lot of different factors. Obviously in residential, there's not a lot of different options to pick from, right? And they're basing it on essentially your income and the comps on the property, right?
Mhm.
Your income doesn't change much, but the comps change a lot, so they're inversely related to the interest rates, right? So that kind of, but that's what they're basing things on. In commercial, you have a lot of different options, and it really depends on what your risk tolerance is. And so uh, if you're someone like me, what I always want to get is very long-term fixed rate debt. And the longest you can get, and generally speaking, is your 10-year, your
Okay.
10-year agency debt, right? Um, but you can get 5-year, you can get 7-year, you can get 10-year, you can sometimes get 12. There's
Okay.
all kinds of different programs that, like, if it's affordable, if it's this, if it's that, you can get different kinds of loans. But basically, you're talking about for a stabilized property, right? Which
Okay.
means that you're not undergoing a major rehab, you have a rent roll, you're at least 90% occupied for 6 months. That's considered stabilized. Your options for that are basically fixed rate, 5, 7, 10, or you can
Okay.
get floating if you choose it, and that's usually a little bit of a better interest rate.
Okay.
Um, you could, but if you're doing like a rehab project, then you get bridge debt, which is generally, well, you can get fixed or floating there too. Recently, before this year, everybody was getting floating rate debt because it was much cheaper. With the way that, with property being so expensive, people were trying to squeeze every penny out possible, and they were getting floating rate debt because it was cheaper, and they believed that rates weren't going to go up. Now, if you were smart a couple of years ago, when nobody thought rates were going up, you could have bought what's called a rate cap, which basically caps it'll allow your interest rate to rise a little bit, but it'll cap it. You could
Mhm.
have bought interest rate caps at like $25,000 for the 5-year life of your loan.
Oh, wow.
You know, as interest rates became more and more volatile, the prices started going up. Now you're talking about like, spending, depending on the size of your loan, like $500,000, $1 million just to buy the rate cap, right? And because everybody knows the rates are volatile and the banks don't want to take the risk now. So people are switching back into fixed rate debt because of what they've seen. But it's a little more complicated an answer. Yeah.
I like it. So let's talk about the 10-year debt. I just want people to realize kind of the variables that are very different than residential. Yeah. Is it fair to say that most commercial debt, like this 10-year agency debt you're referring to, is it amortized over 25 years or 30 years kind of traditionally?
So the agency debt is amortized over 30 years. So so basically you're paying down your mortgage for 10 years and then you have a balloon payment, so you have to refinance, right? And but there's all kinds of different flavors. You can get interest only for a period of time, so maybe it'll be interest only for 3 years while you're doing some rehab, and then it's amortizing for the last 7. There's all kinds of different ways that you can slice and dice that. If you're getting local bank debt, that tends to be 20 or 25-year amortization, and usually only 5 years for those forms of debt.
Gotcha. And then the last question, when you're getting this agency debt, again, just the basic structure, would a waterfall prepay be pretty common? 3-2-1, 5-4-3-2-1, or are there other components?
Yeah. So sometimes you can get that kind of prepay, which is scheduled, or you can get what's called yield maintenance or defeasance, which are similar, but effectively what that is that you have to, if you leave the loan early, you basically have to create a structure where you recreate the stream of payments to the bank, right?
Gotcha.
And it's
make
very
them whole.
Yeah, well, that's what make them whole, but it's like those particular loan programs are depending on this stream of income, and so they don't like it if you cut off the stream of income, even if you give them all their money back, right? What they want is the income, so you have to recreate the income stream by setting up a facility that essentially recreates the income stream, and it's kind of expensive to set up, but it may be worth it, depending on the deal. And the actually kind of interesting thing is some people will get lucky with this, because if you borrowed at a very low interest rate and then interest rates rise, it's actually possible for you to make money on this when you go into defeasance, because because the interest rates have gone up so much that it costs you so little to like buy the instruments that are paying off that stream of payments that you get. There's some money left over for you, so that can happen. But if you're going for that kind of scheduled 3-2-1 penalty, usually you're paying a higher interest rate than if you're going for like defeasance or yield maintenance or something. So
love this. This is all relatively new stuff to me. I'm sure the audience is learning a lot of new stuff. The last thing I want to talk about, besides kind of structures of debt, is also the ease of getting loans. I'm already seeing in the residential space where there are some pretty significant changes. One of them, proposed by Freddie Mac, goes into effect February. Everybody thinks Fannie Mae will copy it. And that is basically making BRRRRs less enticing. Not that they're already difficult, but up until the middle of February, I think it is, you only needed 6 months of seasoning. Freddie Mac now is making that 12 months, right? So basically you have to have the hard money or private money, or however you've leveraged that, more difficult. We're also seeing LTVs fall, right? 20% was very common, then 25, and now we are seeing some loans at 30%, right? Need 30% down. So in your world of commercial, even if rates come down, is it possible for lenders to get tighter, or because it's always about the asset, it doesn't really happen?
Yeah, I mean, in my discussions, and I just recently was talking with a mortgage broker who's also happens to be a student in my coaching program, and he was telling me that the qualifications are still the same, right? So you're still looking at, they're still looking at the quality of the asset, they're looking at the cash flow coverage, and if you're meeting those criteria, then you're in line for the loan, right? They always have the places where they kind of get, I guess, looser or tighter is around the experience of the borrower, right? So, you know, when they start feeling anxious, that's when they start kind of looking a little harder at who's on the team and like how many people are on the team and how financially strong they are and things like that. Whereas when everybody is happy and everybody's making money, you know, and the banks are just, you know, trying to hand out as much money as they can, then you see those things starting to be, you know, there's more wiggle room around the edges for it, right? So I think that's where the tightening comes. It'll be a little bit harder for you know, someone to come along with no experience and without experience on their team to say, hey, I'm going to go buy this building, unless they happen to be very, very wealthy, right? A very strong balance sheet. And obviously, if they're going in with lower leverage, it makes it easier. But to go in and say, hey, I want 75% LTV, I have no experience, it's just a great deal. Trust me, the banks are they were never really happy about that. But, you know, if you know, and I raise the money from other people, right? I mean, they were never
no skin in the game. Yeah.
Yeah, it's not that, you know, or a little skin in the game, but you're not like coming in and saying, hey, I have a $5 million net worth and I want to buy this $1 million building, you know, give me 750. The banks are like, okay, great. You know, whereas if you go and say, hey, you know, I want to buy this $1 million building and my net worth is 250 and I'm raising the equity from my friends and we have no experience, like the banks are, you know, like a little less excited about that proposition. So even if it's the same exact property, right? So that's where I think things get a little tighter when the banks are feeling skittish.
Yeah. So again, folks, the commercial market, the big money, very different game, very different lending structure. This is where Jonathan plays and plays very well. He's very conservative, doing deals all the time. Jonathan, where could people find you if they had questions like this?
Yeah, well, I mean, we have an active Facebook group where you can come and ask me questions all you want. It's called the Apartment Investors Club, and you just get on Facebook and sign up for that. You can also, if you're interested in kind of how this whole thing works and you don't want to have to like read a whole book about it, I've got this.
Oh, there it is. Yeah,
here we go. This checklist. Yeah, it's literally a checklist that you can read through and just in 10 minutes kind of get a real overview of like how these deals work and all the different things that you need to do. You can get this for free if you just go to apartmentinvestorsclub.com and ask for it. There's a button right there. You can sign up and it'll be delivered to your inbox automatically.
Yeah, I got that about 9 months ago. I learned a ton, so I appreciate you doing that. People need to go there. What is the website one more time?
It's apartmentinvestorsclub.com. And oh, by the way, I forgot to mention, if you go to the Apartment Investors Club Facebook group, there is a 4-part video series in there about how these deals work. There's one that gives an overview of how syndications work. There's another one about how, you know, really what you need to do to get deals from brokers. One about how to raise money, and then the 4th one is kind of about the right mindset that you need to adopt in this business. And I think no matter what you're doing, you'll find all those videos helpful. You don't need to be buying 100-unit multifamily deals to find that information valuable. I mean, it'll really help you, you know, with any kind of real estate you're buying, especially the piece about brokers, you know, just about how to get brokers to pay attention to you when you're starting out. Some really helpful stuff in there.
Very cool. Thank you so much, Jonathan.